I'm just queuing up the recording of these. The Integrity product that we're brand new this quarter is working. If I sent you an email this morning, if you go look on the Blackboard links at the bottom, there's a link that says Integrity Classes, and the lectures that I've given in this classroom, I record the screen captures with my voice, and you can go review those. When I first I've used recorded PowerPoints and Flash files for quite a while. The thing that's nice about these is that when I go into depth, I pull in other resources like Excel files and Word files. It all shows up for you to see. The technology has gotten to that point, and these are massively big files that are kept on another server. But the cool thing about them is if you go play with it a little bit, is you open up a session that, a lecture. It gives you a kind of a table of contents that's graphic. It shows you a little thumbnail of all the screenshots. So you can just go click on the screenshot that you're interested in. You don't have to listen to me yak at you for 20 minutes to get to the point you're trying to get to. That's what's going to make it maybe a powerful learning tool for you. I sure hope it is. It's not powerful and useful if you have to sit and listen for 20 minutes to hear stuff you already know and are comfortable with to get to the thing you wanted to hear me talk about again. So I think with that flexibility, students are going to get a lot of use out of this. So go check out that Integrity link, and that's what all this recording stuff is about, to try and facilitate that. Okay, here we are, Chapter 9. We've gotten through what I believe to be the worst part of it, which is the allowance method, accounting for receivables, and the fact that FASB in their need to reconcile with a lot of different interests and groups came up with two methods: balance sheet focus, income statement focus. And we've gotten through those. We've looked at the traps that you fall into as a student when you would answer a question incorrectly because of the way it's presented. And just remember that idea of the brick wall I gave you. Pretend when you're dealing with the allowance method, you have a brick wall between the balance sheet and the income statement. And if you're working on an income statement method, percent of sales on account, even though they give you the data on the balance sheet, the balance in the allowance account, you ignore it. You pretend there's a brick wall there. I can't even see it. I'm not going to deal with it. And the same way when you're dealing with a balance sheet method, percent of receivables, given the data from the income statement doesn't affect your procedure. And you will then not make the mistake. What's the most common mistake? The most common mistake is considering the allowance balance when you're over on the income statement, estimating bad debt from a percentage of sales on account. That's the most common mistake. And it's completely forgivable because students have been doing it on the balance sheet method. They do it a few times and then they jump to the second method. They want to use it again because the problems give you the data. So we got through that, hopefully. Now we have to deal with a minor topic, credit card, use of credit cards in the accounts. We'll walk through that quickly, and then we'll get into notes receivable. Notes receivable is a little more substantial topic, and we'll walk through the slides to present that. Let's talk about credit card sales here. If you're in business now, guess what? You've got to deal with credit cards. I still watch and admire a few local businesses who say cash and nothing but cash. And I haven't been there for quite a while, a year, but I think Red Mill Burgers on Greenwood Avenue, still cash, no credit cards. I think Ezel's Chicken, and both of these, these are food outlets that are really popular. They're great food. Ezel's Chicken in Edmonds, and they have a second location, maybe in Renton, I'm not sure. I've been there for 2 years, but it's cash. If you go there, bring cash. But they're the exception. If you're in business now, you're competing, and people pay with plastic, and you got to get used to using it. So the benefit when credit cards first came around was that, well, heck, we don't worry about analyzing the creditworthiness of a customer. Don't worry about managing accounts receivable. Just use credit cards. Well, in the wholesale industry, that still doesn't work. If you're a janitorial supply service, you're not going to. Your primary method of sales is going to be on account. It's not going to be using credit cards. They're expensive for businesses to use, and legitimate customers of yours expect to be dealt with separately and have their own account with you. But in the past, when credit card companies first came into vogue years and years ago, we'll evaluate the creditworthiness of your issuer. You don't have to worry about it. More people are going to come to you and buy from you because you offer more ways to pay. The risks of the credit, the bad debt expense that we're worried about in this particular chapter, that goes away because we take that burden on. You don't. You got to pay us for it, but we take it on. And most importantly, right here, cash collections are speeded up. The cash cycle is really long for firms that have to sit and wait for their receivable to come in, and that's what gave us this idea that we looked at a couple days ago of factoring your receivables, selling them, or pledging them to a bank and drawing on a line of credit. So, because cash is the killer in business, you're constantly fighting to make sure you have enough as a small business owner. You have to admire entrepreneurs. They take this really heavy burden of meeting payroll and finding a way to meet payroll in competitive environments. It's not easy. Credit cards help in that regard because you do get your cash very quickly. Let's look at this. With a credit card sale, you deposit your credit card slips. In the old days, it was the imprint machines. You physically deposit one of the copies with the bank. It was sort of like a deposit ticket. Now, virtually everybody uses point-of-sale systems where you're electronically depositing those credit card transactions in your merchant account. That's kind of the phrase you use for the account those go into at the bank. There's a service fee, or there's a cost. It says 1 to 5%. Well, if you were a new business and you were selling secondhand furniture and antiques, and you were tiny, and you had no credit history, and you walked into the bank and you said, I want to open a merchant account, I want to negotiate the fee. My transactions are not very big because I sell, a $10 used chair, maybe a $150, it's an antique chair kind of thing. The banks look at those as, low dollar amount transactions and probably high risk that you run into customers who are using somebody else's credit card. They're not sure about you, and so they're not going to negotiate very low to initially establish that merchant account with you. They're going to want a big part of it. They're going to push it up towards 5, and it even can be higher in some situations. Not only that, the bank is going to probably say, if they don't know you and they're uncertain of whether you're going to be around in a month, they're going to say, you know what, too, we're going to have another requirement. You got to leave all those deposits in that account for 3 months, 4 months, sometimes 6 months. And it's because when you use a credit card as a consumer, you have this huge lever, this bundle of rights that come with it. You can reverse a deal. I bought this from them, and they said the chair leg wasn't broken, and it's broken, and they charged me $300 for it. They said it was an antique, and I tried to take it back, and they refused, even though they have a return policy. Credit card company, please remove this charge from my account. I've delivered the chair back to them, and here's the receipt for the delivery. The credit card company will go to bat for the consumer. They'll take that charge right off your account. They don't mess around. You have to follow their procedure, and you have to do it within a certain time period, usually around 6 months. So banks, looking at that, say, you know what, we don't want to give the merchant the cash, the merchant we don't know very well, we're not certain about, and then come find out later there was a whole series of fraudulent transactions. These weren't real deals. These were phony deals just to get cash out of the bank, and they're gone. We skip trace, can't find them. So oftentimes banks say, yeah, after you prove yourself with us and prove that these slips you give us are good, you got to leave them here for a while. That's the other wrinkle. So it's not easy to get a merchant account opened up. And there's other non-bank sources for it, and it's a complicated product to deal with. But there are reasons why the bank has that attitude. then expensive for firms to use credit cards. They pay that fee. When these first came around, there's a big lawsuit by Consumer Group where they said, you know what, if I walk in with cash, I should be able to pay you less in cash than if I charge it. So if your list price is $100 and your fees for processing credit cards are 3%, legally you should have to give me that discount because I'm paying cash. And it was challenged, and it went to court. The court said no. It's up to the merchant. The merchant gets to decide if their cash price is their cash price. So that was defeated, but it still doesn't mean that the government's not going to get involved in credit cards. They just passed this year another huge pile of consumer protections under credit cards, which typically make credit a little more difficult. They make, if you don't have great credit, it oftentimes means you have a little easier time getting it, but if you have good credit, it often means you're going to pay more and face stiffer penalties for things like my payment's a day late and that kind of thing. In the world of paying with plastic, too, I always mention it to the class, there are debit cards. You hear about them advertised by banks. You hear about them being pushed hard, how easy they are, earn points for them, earn dollars from them. Why do banks push debit cards so hard? Because the bank makes more money on a debit card. They don't have to pay MasterCard or Visa their share of the deal. And what I always say to students is remember the difference. If you buy with a debit card, what you're doing is you're giving the merchant permission to go into your bank, walk into your account, and take the money and put it in their pocket and leave. You're giving them that permission electronically. So if the deal wasn't as you expected, you were fooled, tricked, not what I bought, you gave me something else, you have to go undo that yourself. You can't immediately work and say, well, you don't have your money yet as you could with a credit card, and I'm not going to let them give you your money. With a debit card, they already have your money. So it's a lot riskier. It's a lot riskier. And I would not use a debit card unless you absolutely knew the merchant and had dealt with them long term and dealt with them in complete trust. Because with a debit card, you're giving them the key to your bank account. Other things happen, like they goof and they debit it, they hit it twice. Mistake that they'll fix, but during the time you uncover it and get it fixed, you might be bouncing checks, incurring fees, headaches, problems. You know, I always think that the credit card is a safer way to do business, especially because of that return policy and that removal of the charge for legitimate reasons. You can't do it unless there's a legitimate reason, but it works, and it works very well. It gives you a lot of power as a consumer to use it. Okay, on the accounting for credit cards, let's take a look at this. We have Barton Company has a bank credit card sale, $500 to a customer. Bank charges 2% processing fee. How does this look to us? We journalize it. The entire sale is journalized. You don't journalize just the cash you received of $490 and ignore the expense. The sale was for $500. That's a credit to sales. The cash you're going to show for it, though, is less the bank's fee. And that fee, that debit of $10, becomes an expense for you. That's a cost of doing business. That's the 2%. Pretty straightforward transaction there. This is old school. This is how credit cards used to work a lot more often. When they initially came around, and this is true in some relationships now, you were not able to get your cash immediately. They didn't have the relationship with banks as well established and part of the infrastructure. You submitted them through the bank, and the bank submitted them to Visa, MasterCard, who processed them and legitimized them and then sent you the money. So there was a waiting period. So, in fact, you generated not cash from it. You paid the fee. You didn't generate cash. You wound up with a receivable for a while. And you see that here, the debit went to a receivable. This is not as common anymore, but it still could happen in some situations, maybe in some high-risk cards or something. After time passed, the check came from MasterCard, Visa, whoever, and it was made available to you, wired to your bank account, whatever. And so then your accounting for that would be to remove the receivable with a credit and debit cash. the time frame was typically shorter. It's not 30 days. It's not 60 days. It was shorter, but it nevertheless was a delay. Not as common anymore because, the cash cycle is lengthened by this, and what are firms always after? They're trying to get that cash back as fast as they can. So it's not popular and therefore not as common. But it happens. You may run into a question like this. There's a couple of problems I have listed here. Quick study 1, exercise 1. I don't think we have time to go through them, so we'll skip that, but they are examples of credit card sales. They're very simple, very easy. I rarely get misses on them. It's just here because of this accounts receivable idea pops up, and it is a way of dealing with sales on account in the business world. Okay, enough said about that. Let's go ahead and move over and talk about notes receivable here and deal with that part of this overview of receivables in total. So let me pull up our note receivable discussion. And do that. We're accounting for notes receivable. They're an asset. They're on the balance sheet. Let me give you a picture of it first before we start. Over here is our color map of the accounting system. So we dealt with accounts receivable up here. We dealt with a contra allowance account. We wound up with a net realizable value. Now we're down into notes receivable. They're just another asset. We make them bigger with debits. We make them smaller with credits. And in a sophisticated business with lots of notes receivable, they may have a reserve or an allowance for them too, if they have enough of them to justify analyzing their notes receivable for the ones that they may not collect. If they just have a few occasional, it's not worth their while to mess with an analysis of them because it may not be material to the statement. But certainly banks all the time, that's their main asset is loans and notes and mortgages receivable. So they're constantly required by regulation, accounting records, and rules to analyze the value of their receivables. And that's the key of this entire financial crisis we're in right now, is that these massive amounts of loans receivable, home mortgages receivable on banks were of unknown value and they probably still are, because we don't know where the market's going to settle. The bank doesn't know where the market's going to settle. So we don't know what losses are inherent in a bank's balance sheet anymore. And because banks are extremely leveraged, banks have, if they have 10% capital, 10% of their total assets are in capital, they're a strong bank. That's well-capitalized bank. So they don't need much in trouble on the asset side to wipe out their capital. That's the problem. So that's what we're facing right now. So we're going to talk about the accounting for these, and we're going to talk first about what is a note. It's a legal agreement between a creditor and a borrower. In our case, a customer that's going to, in many cases, come to the firm and say, I want some more time to pay my receivable. And the firm would think about it and say, okay, we'll give you more time, but we want you to sign a note. We want you to come in and give us interest, which is why we'd have you sign the note for the time you're holding our money. We want you to give us the legal recourse that we get from notes. It's much that we have many more options to go to court and to force you to pay us when we have a note than if we're simply following UCC law under the rules for an account receivable. So this is a note, has all kinds of things on it, but most importantly, there's an amount that's owed, and that's shown here. What is it, $5,000? It tells you when it's due. It tells you the day it was made. There's a principal amount of the note. That's the amount that's due. The maker of the note is the party that owes the money. The payee is the party that loaned the money. And now these terms are interesting. They don't often pop up in a test, but they might. But you can look it up and double check if you run into it. most importantly, that interest rate, when it's given to you in these problems, they mean an annual rate, unless it says otherwise. So if someone says, what's the rate, and you say 5%, everybody agrees when you say that you mean for a year, an annual rate. Unless someone said to you, what's the interest rate, and you said, oh, it's 1% a month. That's modifying it and telling you exactly what they mean. The default implication is that an interest rate is annual. So you need to know that to deal with these kind of things. Why would you have a note on your balance sheet? Well, all kinds of reasons. But you wanted to finance a sale. You got a customer new. You don't want to open an account with them yet because they're brand new and risky possibly. So you would sell merchandise to them, but you would say, sign a note instead of having an account receivable. So you could get one just directly from a deal. That would happen. You could be in the business of lending cash. You're the money tree or you're a bank. You could give your customer cash directly and you take a note back at interest. And you're trying to make money on the interest you earn on the note. The way we're going to deal with most of all right down here is this third method right here, conversion of accounts receivable. And that is this situation, because we're talking about bad debt this week. We're talking about the trouble that you don't always collect what you want or what is owed to you. One of the techniques to deal with tardy and late receivables is to call the customer or the customer comes in to talk about it, and you say, look, we'll give you more time. We won't send our attorneys out to get you, but we want you to give us something for that. We want interest and we want the additional legal remedies from the note. So they make you sign or ask you to sign a note, which you do if you want to do business with them that way. And so the accounting for it simply removes the receivable with a credit entry. We see down here this credit entry for $5,000. And the debit goes to the new asset. So we're flipping assets. We're flipping the asset from a receivable account to a note receivable. And so our subsidiary ledger for note receivables would have identified the customer name. It is a note receivable from, customer A, customer B. Okay, so that's kind of an outline of how you wind up with a note. Let's look at, once you have a note, this issue of interest accrual is important. And so let's talk about that for a little bit here. When you have a note, you are often given the problem of figuring out how much interest will be due on the note at maturity, possibly, how much interest has accrued through a certain time period on the note. The things you need to do that are, well, you have to have the principal amount that's being carried on the note that's owed to you. You have to know what that annual rate is. And then you have to know the time period. It's in a fraction of a year. It's for our problems. It's because we rarely compute the interest accrual for multiple years. We could, but rarely do. But that component there, that time period, that's the fractional part of a year that you're calculating. Is it one entire year? 1 over 1. Is it 6 months? 1/2. That's the technique we used. And in that process, in these problems, we use this old method that was used before computers made it easy to compute interest. We use the 3360 convention, it was called. It's not common anymore because computers do interest quickly and without effort. But this 3360 convention said, you know what, we got this goofy calendar with 28 days in February, 29 on leap year, 30 days in September, some months more interest, some months less because of different days. That's too much calculating for us. Let's pretend as in this deal, the borrower, you agree to this, the lender agrees to it. Let's pretend the year is made up of 360 days, magically. Let's pretend every month has 30 days. So 12 times 30, 360. That's what was done, and it made the computation easy. And you would say, well, is that going to cheat me? Well, it really doesn't, because sometimes it might be in your favor, sometimes it's in the bank's favor, depending on where you are in the year and what the day is. But, over an entire year, it's exactly the same whether you use actual days, 365 over 365, or 366 over 366, actual days, or the 3360 convention. You get the same interest either way. It's just for partial years, it can be a little different. But if you both agree on it, it's okay, it works. And that's what we're going to use here. We're going to use the 3360 convention. So this is a 6-month note. That's why you see 180 over 360, or 1/2, to plug in for the amount of time that's passed to compute the interest. So we see $2,000 in interest accrued. What's important here is this was a 6-month note, and it was originated February 1st on the books. We're looking at it maturing before the fiscal period ends. 2 plus 6 is 3. It's done in August. And so we don't run into a fiscal period. If we had run into a fiscal period, we would have had to accrue the interest that was earned but not yet received up to that point, and we would have had to made an adjusting entry. We'll see that happen. But here it's simply straightforward. When that note is due, the borrower will owe us $2,000 of interest plus the original principal amount. So the value of the note at maturity, that's a question they often say, what's the value of this note at maturity? It's the 50 plus the 2,000. 50,000 plus 2,000. So we can see the receipt of that note in this journal entry. Look at the cash there received, $52,000. Look at the credits. One credit says, if I get the cash, I don't have the note anymore. I got to remove the note with the credit entry. Note receivable 50, credit 50,000. Part of the 52,000 cash is for that $50,000 credit. And then the other credit is interest income. It's a revenue account. You make them bigger with credits. It fits. It's logical. That $2,000 goes to interest income. It's a revenue for the time period. That is balanced. It gets posted, and away you go. Very simple. Okay. So, and the date for this was July 1, I guess, is when this came in. Okay. Let's take a look at what can happen, though, to us. What can happen is that we have a note, in this case, $24,000. It has a 90-day maturity. It's due in 90 days. It's a 10% rate. You receive the note on November 1st. I can tell you that many accounting problems have notes due on November 1st, and received on November 1st and due in the next fiscal period. And there's a reason why they picked November 1st. And the problem is because many students make a mistake in counting how many months to the end of the year. And it's a mistake that we all can make. But they think, let's see, I'm in November, December, they say to themselves. So I got 1 month of accrual. No, you have 2 months. You have November plus December. And I want to point that out because I don't want to call it a trick. It isn't a trick, but they choose it because they get mistakes from it. You're not going to make that mistake anymore. You're going to watch out for it. So when someone says, how many months have accrued by December 31st on this particular note, you're not going to say November, December like this. You're going to say November, December, 2 months, 60 days. And that's why we see 60 over 360, the simplified convention we're using, times 10%, 0.1, times the principal amount. $400 of interest income will accrue on this note at the fiscal period end. We have to do something then. And these accounting problems set up for you in the book and on the test, you need to do this. You need to adjust for that. You haven't received the interest yet. It's not due until 90 days pass. You've been through 2/3 of it, 60. You got to accrue it. So what do? You open up your journal. You say, I'm making an adjusting entry December 31st for that $400. I've earned it. Time has passed. They owe it to me. There's no dispute about that. So I'm going to debit what? Not the note receivable. We don't, as a practice, mingle interest accrued with the principal amount because it confuses us. It messes things up. It's not that it wouldn't work. We couldn't figure it out. It's just that it's not clean. Keep the principal amount there because you're going to use that in your journal entries and calculations in the future. So we don't debit the note receivable, which might be a logical approach. We set up a separate account. Interest receivable, also an asset account. It gets that $400 debit. And the offsetting entry is interest income. So we've earned $400 we don't have yet. That's accrual accounting because we have a right to receive it. So we okay with that one, that adjusting entry? The hard one, the one where you make your mistake, is the journal entry for when you receive that cash. We got to be really careful. Let's take a look at that here as we go down. When you receive the cash for that note, the total cash received is the 24, look up there, debit to cash, and the 600, let's think about it. It was 400 for 2 months, one more month, 200. Yeah, that makes sense. $600, $200 a month accrued, because every month has, magically 30 days. So that's the debit to cash. It's the credit side of this where you got to watch out. You wipe out the note, $24,000 note receivable is credited. Get it out of there. I don't have it anymore. I got cash instead of the note. But don't run down, as students do, and say interest income $600. If you did that, you would be counting 400 of that 2 times. You already accrued 400. You only want to accrue what was earned in the new fiscal period that you're in right now. You only want to accrue $200. So interest income $200, and then logic, if you thought about it, says, oh yeah, I'm receiving that $400 interest receivable that I have accrued already. I got to wipe that out. It's a normal debit balance asset. I'm going to wipe it out with a credit entry of $400. So what's the mistake you make? As we think, we say, oh, it's interest. Oh, then they earned $600 interest income. So I'm gonna record that. Whoops, I forgot that they had already recorded 400 of that. Can't do that. We have to be real careful. The problem is set up like this. This is how these problems are. When you have an intervening fiscal year in, this is what they want you to do. That they do it intentionally. So watch out for that as we go forward. So let's practice a couple of these here if we could. If we look at our book, Quick Study 5, and I'll pull it up on the screen for us here. Quick Study 5 has a little note receivable problem that I'd like you to give a try to. This note receivable is listed at $9,000. You're going to make a journal entry. You're going to find most output in this course is a journal entry. See if you can pull together the ideas you need to make that journal entry. I'm going to pause this recording here for a second.